Mortgage and housing activity is finally showing signs of recovery after 2 slow years, and experts expect 2026 to bring more momentum. According to MBA chief economist Michael Fratantoni, the improvement will be gradual, not dramatic, but the direction is finally positive. The Mortgage Bankers Association is projecting an 8% increase in single-family mortgage originations, reaching about $2.2 trillion in loan volume and 5.8 million loans. While that looks healthy in dollar terms, the number of loans shows the market is still cooling compared to past decades. Even so, home sales, both new and existing, are expected to rise about 5% next year as inventory improves and more buyers return. One of the biggest drags on activity, the rate lock-in effect, is finally loosening. Millions of homeowners still hold 2 to 4% mortgage rates, but more are choosing to move anyway due to life changes like marriage, children, divorce, or job relocation. At the same time, nearly 50 million millennials are now in peak home-buying age, which will continue to fuel demand in 2026. Mortgage rates remain the wild card. The MBA's baseline forecast assumes 6.25%, but rates could drift either direction. If the economy softens and unemployment rises, rates could fall towards 6%, and if inflation heats up again, they could move towards 7%. A drop into the low fives could push loan volume up sharply, even toward $2.8 trillion, while a rise of 1 full percentage point would pull activity below $2 trillion. Borrower behavior is also shifting. Adjustable-rate mortgages, ARMs, are gaining traction again, already about 10% of new loans, because they're often a full percentage point cheaper than fixed rates. And while the Fed is expected to cut rates again in December and early 2026, officials remain divided as the labor market cools. The biggest risk for next year is rising delinquencies. Unemployment is expected to increase from 4.3% to around 4.7%, and because hiring has slowed and layoffs are picking up, distress could become more visible. Unlike the red-hot markets of 2020 to 2022, today's slower market means struggling borrowers may not be able to sell quickly, leading to more long-term delinquencies and a modest uptick in foreclosures. Some of those distressed homes could become rare sources of new inventory next year. Overall, 2026 is shaping up to be a slow but steady recovery. Origination volume should increase, inventory will continue improving, and first-time buyers, especially millennials, will play a growing role. But the outlook still depends heavily on interest rates, job stability, and how buyers and sellers adapt to a very different post-pandemic housing cycle.